Hello, welcome to today's session. I'm Ronald with Indicator Vault, and today we're in Tradingview, and we're just kind of do kind of like a trade recap on a couple different pairs that recently happened, specifically this move up here. And we're going to go over QM patterns, or what's called Quasimodo patterns. And it's a pattern, but it's essentially built around liquidity and liquidity grabs. And we're just kind of have a brief intro into what those are, and also how to incorporate some divergence into them. And in a little bit, I'm going to add on our Divergence Solution panel and the indicator and go over basically just that and how to incorporate it and how that actually would have played a role in catching specifically this move here that happened yesterday. So you can see I'm on the Euro US dollar chart, hourly chart. So let's dive into it. So first thing I'm going to mark out is this demand area. Specifically this area, because this is the demand zone that broke this high. This is a significant high here. We can see clearly broken. So we know this zone is going to be relevant. We have our eyes on it for some type of reaction whenever it does get hit. And obviously we had to wait a little bit, but then finally gets touched just yesterday, actually. One thing to note also is going into yesterday, this zone is becoming more and more relevant to me as I see price, kind of keeps making small attempts, mostly here, kind of here, but then even yesterday here, or 2 days ago here, but doesn't touch it. And so there's lots of lows that price wants to break for liquidity to get grabbed before it reaches the zone. And so we see that happen. We see on the hourly chart, price never even closes below the top of the range. And I believe I've mentioned before, but specifically the 50% mark of these zones will be the most sensitive. Actually need to include that. So we can see it's less than a pip away from actually touching it. Put a line there. Oh, and also, if you right click on the screen, go to object tree, it'll show you everything that's on the chart. So price reaches here. So it has our attention now. Not just that it's touched the top of the zone, but it's now reached into the consequent encroachment, the 50% mark of it. So here is the basics of the QM pattern, the Quasimodo pattern. One, you want liquidity to be swept. So like I mentioned, something like this. Seeing these, you can call them equal lows. They're obviously not exactly equal. The relatively equal, where you've got this low, these two small ones here, but never dip below here. So there's some liquidity building up here. So first step is basically a stop hunt. Price shoots down, runs any resting stops. Maybe there's some sell stops below these lows, or maybe traders who got in long and prices starting to go their way, then it aggressively will take them out if they had any trailing stops. Maybe they trailed it to here or to here. So price takes them out. So we'll identify this as our stop hunt. Next is you want to see a break of structure, and specifically you want to see a break of in this case, the high that caused the stop run. So you could essentially identify this one. For me personally, I would not have. I would have waited for this one right here. Why? Just because this high is just not significant enough for me. It's just not super obvious. Yes, it could have, depending on your style of trading, you can count it. I just would not have counted it in this scenario. Maybe if it poked up here a little bit more to create a more significant high, but this is just not as noticeable to me. So, and also for my personal style, I prefer a candle to close above it, not just wick above it. So we can see here, this red candle does wick above it, but doesn't close until we get this next one that closes. So that is the second part. It's a break of structure. Specifically the high that caused the stop run. Not this one or this one, because these, in a sense, supply zones are not responsible for running the stops. Now the third part, and this can be a little bit more subjective. These are the two, the stop hunt and the break of structure are the two most significant pieces of information and patterns that you need to notice. The third that I personally like to wait for is as it retraces back down to find liquidity for it to take. And these are in the form of, whether equal lows. For instance, maybe over here, price does something like this, where it just kind of consolidates for a little bit, never really goes below here, creates, just some equal lows, or maybe like a small trend line like this, sort of slowly going up, this direction, and then it spikes down, taking all of that liquidity. Obviously, we see it does that and runs up, but let's mark out some obvious zones. So this is one. Obviously, this is a new demand. This is not necessarily the demand that's responsible for breaking the structure. Yeah, this one here, but we're not paying attention to this high. You can, if you want, if you're okay with that risk, go for it. But for me personally, I'm not okay with that. We do have this one. This is not quite as clear as I would like. Just these three small candles. I don't really want to pay attention to that. Now, the most conservative and to me the most obvious is actually just below this demand in the form of this gap here. Let me get rid of this. Liquidity can form in gaps like this, where you see this red candle, this high is right there, and then the next candle, its low is right there. And so this candle is just one single push up. So that's a gap. And then maybe another video we can cover how it also overlaps with this bearish gap. So this zone right here has my attention. Not to mention that it would also fit my risk parameters. So you could potentially count this as liquidity because it is a low. Even this as a low. And of course, I would pay attention to that since it's right overlapping with this gap. So a number of confluences adding up for me to pay attention to this gap. So in a sense, the third step is for liquidity to be built up and then taken. And I count gaps as liquidity taken. So, just hypothetically, if you got in this trade at the top of the gap with your stop below the low, about a 14 pip stop. Now, not just this low, but I now count this as a strong low. If I see the stop punt and I see the break of structure, I'm now viewing this as a strong low. And if my bias is right, price should not run below this anymore. If it does, then I'm sitting on my hands and waiting for another setup because it's now become invalidated. Everything is, my foundational piece now becomes that price is going to stay above this low. So, for instance, if you just held for just creating a new higher high, just over 4 R&R, if you held to kind of this supply area over a 6 risk to reward, that's a great trade. And even more great is that it happens quick. You don't have to wait around and watch it consolidate. It was extremely quick and fast getting to its take profit area. Now, let's get rid of all of this. Now let's bring up the solution panel, which you just see popped up in the indicator. So, one way to use divergence, and of course you can use this with any oscillating indicator, RSI, stochastic, Williams percent R, money flow index, whatever you're comfortable with, will show divergence with price in many ways. With our indicator here, let me just quickly go into the settings. You've got, you can also, up here, you can see it will give signals with take profit, stop loss. You can turn that on or off. You've got the MACD and the RSI, and you can change all these settings to what you're comfortable with. Change the look back range. And what's awesome about this is it will plot regular divergence and hidden divergence. In this case, I'm just going to hide the hidden. You can see here where it was plotted. Now it's not. And then just all these other settings. So you can customize it however you would like. Now, here we've actually got it plotting on the closes here. But I love to use divergence or kind of interpret it to validate stop runs. Because that's essentially what divergence is showing us, that price is doing a fake out where we see it aggressively trade down here, but the divergence is showing us, that's actually just a fake out. It's running for stops. The true move is going to be bullish. And so we see that with this down move. And there's other ways to plot it as well. But for instance, if you just took the lows, basically the same move, this low, and then this low goes even lower. But what does the indicator tell us? If you take that same low, I'm basically plotting that green line here. The indicator is going higher. It did not make that same low. Let me pull it up even more. See this upwards trend line that it drew? So that's basically validating this stop run. And how almost precise can you be that it's telling us the stop run is happening as it's hitting the 50% area of our demand range? So that's validating in my mind the stop hunt, that I just had marked out. Stop hunt, break of structure, comes back, grabs liquidity, runs off. So that's just a brief intro into QM patterns and even our divergence indicator. You can see it's given some other signals, but this is all on the 5 minute. You can zoom out to the 1 hour and still see divergence play out. But back-to-back days, and this is today's move. This is supply. This is valid supply because it caused a move that broke a significant low. So this has now become a significant POI to us. So that's the 1 hour zone. We'll just drop down into the 5 minute. Actually, you can play around with time frames. Just quickly, the 15 minute, you can see here. Also, actually, before I go too far, use this in confluence with, for instance, supply and demand strategy. So as it's coming into valid supply, our bias is now become bearish, right? We're expecting a down move. And so that's going to filter out this bullish divergence. We're not, don't let it play, tricks on your mind that, you see this and all of a sudden, oh, I've got to, switch my bias now. That's part of the psychology of trading. If you're going to last long, you've kind of have to have some steel nerves and, a strong mental game, right? So if you're confident that this is going to sell off, and this was today's move, the sell off, wait for a bearish signal. This is a false signal, which this is what happens with any indicator. Use this in confluence with your trading strategy. But I want to show that on the 15 minute is we do have the bearish divergence show up with the indicator. But 5 minute gives some more clarity, as it usually does. So we see this high taken right here, right? So in a sense, a stop run, and I believe there was kind of another high way back when that it took as well, right? So this, you can see this as a stop run, but I would not mark it out yet and view it as that. Why? Because you don't get a significant break of structure from the low that caused it. Let me zoom in even more. This low that caused the stop hunt, you see a break here. That's just not convincing enough for me personally. Two, during these hours, it's the Tokyo session, which is going to be low volatility anyway. Another tip for you, you'll see things like this during the Tokyo session because it's just not very much volume. So you want to see a more significant break of structure. Also, just because it's the same candle, that's another teaching, but because it's the same candle that runs it and then goes below it, that's just showing me kind of a, nonsensical movement. So wait around. So now we get another push up. And here's the thing, even if you did get in that, you would have quickly been stopped out. Another reason why I would not have taken this, well, I shouldn't say another reason, but it's the same reason that the same candle that that took the stops, that did the stop hunt and broke the structure, doesn't create any POI to trade off of. There's no liquidity for it to grab now. So there's nothing to say, okay, well, when it gets up to here, that's where my entry will be. There's nothing to enter on. So you just ignore it. So, but here we have the actual stop run, runs above here, runs above this low, break of structure. So let's put that as a stop run. Here's a solid break of structure. The low that caused the stop run has now been broken, and in doing so now creates a valid POI, a valid zone to trade off of. And then as it plays out even more, we see another gap form. You would originally mark it out like that, but then plays off of here. And if you felt like getting in on this candle as it broke above this gap, fine, that's great. You could do that with your stop above here if you manage your risk accordingly. But remember what I said at the third step. Let's mark these out. Stop hunt. Break of structure. Got this high, you've got this high, you've got a gap. So as this high is forming, I'm thinking, okay, it wants to run above here. And if it's going to run above here, it's at least going to tap into this gap, if not this order block. So these here I'm seeing as liquidity that's now being taken. You remember on the 15-minute, we had bearish divergence showing up as price is hitting our POI, as it's hitting our supply zone. Trying to see. No divergence showing up here. But again, on the 15-minute, it shows up as it's hitting our bearish supply zone. Sorry to clutter up the chart. That is even a perfect hit. Into the fib 61.8, 70.5, and even look at how the fib levels on the bottom and top of the gap are lining up pretty well. Picture perfect trade there. Even if you counted this as the break of structure of this low, if you counted this low as the stop hunt, it then breaks it here as well. So many confluences to then get in. Keep that up there. So today, going short, you just entered at the bottom of the gap. About 18 pip stop, relatively large for my taste. Just to create a new low, but you've got these huge gaps. And then just like yesterday, how we traded into the bearish supply for over 6R, you could trade to the top of the bullish demand for 3.6R. Obviously, it runs even deeper for a little bit more for over 5. But that's kind of the basics of the QM pattern. I hope this has been helpful. Let's go into Australian dollar. Did want to show this pair first before we end the call. I believe it was on the 15-minute. Yep. So have this, got this demand zone marked out because it's responsible for taking out this high. Now, a couple things to notice. We see it does hit here and could have taken a trade on a smaller time frame because we see it runs the stops. I'm sure on the 5-minute or 3-minute, this would be a break of structure. See it dip back down and run up. But we don't see it take out this high. So as it comes back down in here again, we're a little leery. Okay, is this demand going to hold? Because we should expect that for it to create another high after it touches it. But, depending on your risk and how you want to trade it, you can allow for 2 or 3 touches of a valid supply or demand zone before it becomes, irrelevant. For instance, if it touched here and wasn't able to break this high, I would have gotten this off of my chart and probably would have started having a bearish bias. But this was around the same time of the euro trade we just went over. So again, it's coming into our bullish zone. We can see bullish divergence taking place here, just like we saw on the euro, telling us this is a fake out. And not only there, like I marked out as well, even if you just do the lows and not the closes, price goes below. whereas the indicator is actually going high, showing us this is a fake out. Price wants to go bullish. And here's the thing of trading. We can see the Aussie went below this low, whereas the euro, see this gap? The euro respected this gap here. So as far as between these two, the trade definitely was with the euro yesterday. And there's a number of reasons why it would not have respected this low. So for instance, let me zoom in again. We did get the valid QM pattern. We had the stop hunt here with the divergence telling us. We had this high and even this high, although I would have been looking at this high, was broken. So we then have the break of structure. And so we could have reasonably expected this low to stay. Now, the reason I don't think it did, you see it even went below here, is just because of the weakness of this demand zone. Like I mentioned before, how it had already been tapped into a couple times. And so price is not going to as aggressively spike away from it. Obviously, it easily could. And we see it did move up. There's still a great move up. This was FOMC yesterday. But the reason I wanted to dip into it one more time or take these lows is just because this zone was losing its strength, in my opinion. That's how I view the market. But we still did see some bullish divergence show up. Our bias was still bullish. And so this one wasn't as clean as the euro, but that still was a valid QM pattern that showed up. So that's going to be it for today, for this session. I want to introduce a little bit of divergence with the Divergence Solution indicator. And again, like I pointed out before, even on this one, I had the hidden showing up. On the euro, I got rid of these. But, hidden divergence is even a whole thing in itself. If you just want to show the hidden as well, where it's the other way around, that's a great trading style to incorporate as well with other confluences. But I hope this was helped as far as QM patterns, spotting actual stop runs and fake outs in price, and how divergence can help, interpret that. And, to introduce the Divergence Solution indicator along with the panel. And, it's a great tool to have if you want to incorporate divergence. Even will give signals, which I didn't even go over that. We could go over that in maybe a future video. But I hope this was helpful. And until next time, best of luck trading.